All right, guys. So we are doing our first Q&A, and we've got Rick Fields on. Rick is CPA, the managing CPA owner at Associates in Accounting. And we're just going through a few questions that we've received in the past week or so. And I'm going to read off the questions, and then Rick is going to give us some of his wisdom to answer these questions. So first question we've got, Rick, is from Joey in Florida. He says he's a U.S. citizen, and he has a friend who's a resident of Hong Kong, and that guy is a non-U.S. citizen, and he's saying zero taxes on capital gains in Hong Kong. So he's considering temporarily gifting his crypto to his friend over in Hong Kong. His understanding is that his friend won't have to pay taxes, or that he won't have to pay taxes on the gift transfer, because the gift tax is only due when he uses up his entire lifetime gift tax exemption. And so his idea is to give it to his friend, have his friend sell it back into a different coin, and then eventually gift it back. He says this feels too good to be true, but wanted to get some advice from a tax professional.
Yeah, no, that's a great question, Joy. Thanks for the question. We love questions. We always like to answer them. So that being said, what you suspect is mostly true. There are a couple of hiccups in your situation that we want to talk about for just a couple of minutes. First off, you absolutely can gift it. And yes, right now today, in theory, you have an $11 million plus gift allowance in the U.S. estate and gift tax laws. So my guess is that this is less than $11 million, and you're going to be able to make this gift without any implications. You do have to file a gift tax return if the value is more than about $15,000, but there will be no tax due. It's just a functional thing that you have to do. So yes, your friend in Hong Kong obviously isn't subject to U.S. taxes. You get to make your gift. The gift ends up being a non-taxable event to him if he sells it. And what he decides to gift back to you in the future is absolutely going to come back to you without these income taxes being attached in any way. A couple of things about this. The IRS would challenge this if they believe that there was a deal. If you were actually in an agreement with your friend that I'm only giving this to you with the understanding that you're going to give this back to me. A gift is a gift under the tax laws only when it is free, clear, with no future expectations or obligations. So certainly keep in mind there can't be any agreement with regard to some type of exchange in the past, in the future. If so, you've sold them. You've not gifted them. The other thing to keep in mind is that Congress is playing around with a bill right now, and that particular bill is, in theory, going to change gift tax and estate law. Now, the version that's out there today is going to take these numbers from $11 million down to about $5 million. My guess is, unless you're ultra wealthy, that doesn't affect your decisions at all. However, one of the things that Congress does is that they will put the bill effective dates in some cases back to the date that the bill was announced. And again, in the current version of the bill, which is not agreed to at this point, as a matter of fact, there's a lot of difficulty getting this through Congress. So in the current version of the bill, nothing that's in there would affect this decision on your part unless these gifts are above $5 million. However, we don't know what the final version looks like, and we don't know exactly what the effective date is. The current version says all the effective dates on the estate and gift tax are going to be in 2022. So again, this is a little teeny tiny warning bell that you can't do anything about anyway. That if you're going to make this move, you should go ahead and make it. I don't believe the bill will affect it. But again, the little small asterisk is simply don't know for sure. Could be some implications once Congress writes a final version of this. I would say not. I think that, most of us are not real fond of our congressional representatives right now anyway. And if they wanted to make this retroactive back to a date before now, we might be picking up pitchforks and lynch ropes and heading for Washington. So just kind of keep in mind that I think you're okay.
And just to clarify, one other thing is the $15,000 limit, is that based off of what it's valued at the date of the gift, or what he bought it at?
It is absolutely based on the value at the date of the gift.
Cool.
And again, the only purpose for that gift tax return is to show how much of your 11 million or 5 million, if the changes get made, that you've used up. Because, hey, you've still got life ahead, right? You might make future gifts or leave money behind at your death. So with that in mind, Uncle Sam keeps track of that by virtue of those gift tax returns.
Cool. Okay, Joey, I hope that is helpful. All right, the next one we've got is from Amanda in Kentucky, and she's talking about some gains that she's got, she has approximately $15,000 in realized losses in an investment account year to date. She's not sold any of her winners. What she'd like to do is sell some and roughly balance out the losses. And what she's really getting at is, can I immediately rebuy the stock without worrying about wash sale or any other stuff that I'm not aware of?
Hi, Amanda. The short answer is most of what you suspect is correct. Let me comment for just a couple of minutes. This is a common investment strategy. Basically, you're balancing your losses and your gains. A lot of financial planners will advise that. We frequently advise that as well when we're doing tax planning for our clients. So you're on the right track with your thinking process. As far as the wash rules that you're referring to, they only apply to losses, which means that if you harvest a loss, which you've already done, and rebuy those securities within 30 days, the loss ends up not being deductible for tax purposes. But in this case, you're talking about selling off some winners that you may want to rebuy within 30 days. And the short answer is no problem with that at all. The one other thing that I would caution you about, don't know anything about your tax circumstances, but $3,000 of these losses are deductible over and above any gains that you have. So you said your loss number was 15,000. Even if you only harvested $12,000 worth of gains, the other three could have impact against your W-2s or any other income that you have. So just another fact for you to consider when you're making these decisions.
Cool. Okay. All right. Next, we've got from Jasmine in Utah. So this one's kind of interesting. It's, how do I avoid income tax on life insurance distribution? First, I understand that life insurance is post-tax, so recipients are not subject to it. But it sounds like Jasmine, her father's wish was to put her and then the father's wife on the policy, but never got to do this. So essentially, this money is coming out into Jasmine's possession, but it is going to be counted as income. And she's asking, is there any vehicles out there that can get her out of the tax, since she was not specifically one of the beneficiaries of the policy?
Okay, Jasmine. Wow, this is not a simple question. I love the more complex questions. Makes our brain synapses fire, right? So let's take this one head on. A couple of things about your question. I think your assumptions are wrong, but understand that we've known you now for about 30 seconds, right? And so we really don't know everything that's true about your tax situation. I'd love to have more information to give you a more thorough answer. Here's what I'm going to tell you. Basically, what I am hearing is that life insurance always denotes, when there's life insurance proceeds, we're dealing with an estate situation. Somebody's died or there wouldn't be life insurance proceeds coming out 99% of the time. There are some situations in which a policy could be cashed for other reasons, but I'm going to guess that that's not your situation. Somebody has died and left behind these proceeds. Unfortunately, they weren't directly given to you as a beneficiary. So that means you're going to get them in one of two other ways. Again, a lot of assumptions here, and we'd love for you to fill in the blanks on these assumptions, and then we can give you a better answer. One way you might get this is that these life insurance proceeds are going into the estate because beneficiaries weren't designated, and then they're going to be paid out to you from the estate as a beneficiary of the estate. Again, here are all the assumptions in there. These may or may not be accurate assumptions, but assuming that they are, and I'd say that this is a likelihood based on what you are telling us, that life insurance retains its non-taxable trip through the estate as it comes to you. So it's not going to be taxable just because you were not a direct beneficiary. It's non-taxable when the life insurance policy pays out, and it retains that non-taxable characteristic as it moves through whatever pathway that it gets to you. Let's assume for a moment that you're not even a beneficiary of the estate, scenario number 2, but that somebody is saying, we really feel like you should have gotten these proceeds, and they're going to make sure that you get them. That could be in the form of a gift, could be in the form of some other transfer, but nothing that I've told you so far would change in those scenarios. The life insurance proceeds are non-taxable coming out of the policy, and they retain their non-taxable status, whatever stations they go to before they get to you. So again, unless there's something very different than what I am hearing, I don't believe you have an income tax implication from this transfer at all. I believe it's going to be non-taxable money, and that's probably the best news you're going to get today, right?
Cool. Okay, sounds good. And then the last question we've got time for today from Justin in Kentucky. Is it possible to reduce tax liability on back pay? So Justin knows someone who got a few years of back pay this year. Is it possible to dump this into an IRA or invest it somewhere else to reduce tax implications for the year? He says he realizes it can be elected to impact prior year's returns payable this year, but that is a very minor difference from the lump sum tax. So, and it sounds like there's slightly different tax brackets from year to year.
All right.
Just trying to see if there's ways to get out of that.
No, Justin, again, not a real simple question. Hey, folks, with all of these questions, one thing to keep in mind is whenever anyone's doing this armchair quarterback type of thing that we're doing on these videos, we don't know all of your circumstances. So you definitely need specific tax advice, whether that's us or some other tax professionals. You need someone to gather those circumstances and confirm that this advice is correct. So nothing that you hear today should be considered definitive until you put all of those facts in front of a tax professional and allow them to advise you. That being said, I'm always glad to give you an opinion on your question. So your question is, hey, here comes some back pay. I would think presumably from an employer. It was awarded for some reason, and that's very important in this. We're going to talk in just a moment about why that matters. It was awarded for some reason. This back pay comes along, and now there's taxable consequences potentially in the year that it's received. And you're talking about the ability to go back and apply this to prior years. That's an interesting concept. It doesn't work in a lot of situations because most taxpayers are considered cash basis. And even though you may have received the money for 2017, for 2018, for 2019, other years, you receive it in 2021, and now there's tax implications that come out of that. And so while there are some specific situations that will allow you to take that money and apply it to other years, those are pretty narrow. There's not a lot of circumstances that allow that to happen. So there used to be rules. If you're old enough, you might remember things called income averaging, and the rules that used to kick in whenever your income would spike in a particular year. There were things you could do to moderate that. Once the tax law shrunk the number of tax brackets and lowered the upper tax brackets, all those types of things went away. So the short answer is, assuming this money is taxable, it's likely going to be taxed this year, and it's likely all going to be taxed at whatever rate that applies in this particular individual's tax bracket scheme with their other income and everything that comes in. Now, my point I made early on in this answer, whether or not this is taxable at all very much depends upon why you received it. And again, these are complex tax issues, but I'll give you a 30-second story that will point out a circumstance that could be very similar to this, that may or may not, but it ended up with the net result of not having taxable consequences because of the reason that the back wages were awarded. Sexual discrimination charges, racial discrimination charges. A lot of these things are considered violations of the Civil Rights Act. And when that happens, there's a very different set of tax rules that apply versus Same with age discrimination. There are just a number of circumstances that can often result in an employer having to pay back wages that may or may not create taxable income. So before the assumption is, oh, it's back wages, therefore I have to pay, you have to look at the circumstances that actually created the calculation and the payment of this. It can be a lawsuit. It can be in lieu of a threatened lawsuit. It can be a labor arbitration type of award. It can be something that's awarded by wage and hour because you weren't properly paid your overtime pay. And all of those have very different tax consequences depending upon which lane of that multi-lane highway of back wages, which lane determines different tax consequences. So don't automatically assume that it's taxable. Check that out first. And then when it is, assuming that it is, you can talk about options as far as when the taxes have to be paid on this.
So assuming it is taxable, you're still subject though to your IRA limits for the year, right?
You are. Now, again, a couple of other things about that, and this is where good gifted tax planners come in, is that a lot of times you'll find ways that you can manipulate your other income. For example, suppose that this individual is employed on another job and has access to a 401k. They might decide to max out their 401k for the rest of the year and be able to defer much more than they could through simply making an IRA contribution. So there are options along that line. It's also a good opportunity if that individual is charitably minded to look and see if it makes sense to do something along that line between now and the end of the 31st of December. Or if they have small businesses or other tax consequences, again, there are just a number of circumstances that can affect the overall picture outside of this one single transaction that you're describing to us. So I think that it's really important that this individual gets some tax planning help from somebody that's competent. Let us or someone else lay out this model for you that says this is what your ultimate numbers are going to be, and then you can make much better decisions on how you want to approach this.
Yeah, no, that's super important. I mean, especially if, say, you're not working and this is all you get for the year, and if it's under your standard deduction, there's no tax consequence. So like Rick said, there's a lot of different things that come into play. And so having someone with the full picture is always going to be best case scenario. But, anything that we can give on these videos, on this recording, just to give you guys a little bit more clarity, it's always going to be good. And we're going to try to plan to do these a few times a month when time allows. And so hope this was helpful. If this triggers any additional questions, feel free to leave those in the comments and we'll get back to those. And thanks so much for watching, listening. Have a good rest of your day.